Welcome to the second video of the series ST2 or Life Insurance by Gopal Goel. Like the first video, we do not cover any concept of the chapters of ST2 in this video. Again, this video is designed to introduce you to the subject and to the exam ST2. So, the first thing that we discuss in this video is typical personal financial life cycle of an individual. Zero to 16 we consider as non-working age, and this is true for most people except child artists or child models or a prodigy like Sachin Tendulkar who becomes a player and starts earning before 16. 16 to 65 we consider as working age or productive age. Productive means economically productive. And 65 and above, this is again non-working ages, most retirement. Again, there are exceptions. There are people like all of Indian politicians, all union cabinet ministers are somewhere around 65. Mr. Manmohan Singh was our Prime Minister well up to his reaching age 81. So there might be exceptions. So what is important is to note down typical, right? Even Justin Bieber is an exception here. All models and all actresses are exception. Hardly any actress would be working till age 65 unless and until she accepts being cast in character roles. Right? This may not be true for army men. Army men retire much earlier than 65. In India, Navy retires its deep sea divers at age 36. So, but typically this is the personal financial life cycle, and exceptions are, considering the size of the population, exceptions are few. So, let us start discussing ages 65 to 25. Typically, we find that either the person is into higher education, during these ages, or may have already joined some employment, full-time or part-time. This is typically observed for ages 16 to 25. Of course, we may have some finer partition. We may consider 16 to 21 separately and 21 to 25 separately. The purpose is in ST2 is not to go into these fine details, but to understand that at different ages we have different financial needs and we have different financial resources to meet those needs, right? So now let us focus on this. Typically what we find that people at these ages, and I think you must be one of the person in this range, or if not, then immediately the next age range. So what we find is that Individuals in this age range typically have some family support for finance, for their parents or their elder siblings, or some aunts, uncles may support them financially during this period. Some of them during this period may have also started earning and may have also started saving for future, for their dream home or for their dream vacation, or paying off education loan. And this is also considered to be the age of living your desires and aspirations. So people at these ages are more likely to spend money if possible, if they have access to. So saving and living the life is more important motive at these ages than saving money for future. वो भी तो जिंदगी पड़ी है, कर लेंगे saving, right? Of course, if you do not go into higher education, then this period may be short, or it is quite possible that you have an education that you can follow together with your employment. Next age range is 25 to 35, and in most developed countries this is the age range in which people settle down into marriage. Of course, in India also the marriage age is gradually shifting upwards. There was a time when people used to marry in their early 20s, like 22, 23. There will be a hue and cry from relatives, well-wishers and neighbors. शादी नहीं हुई अभी तक, शादी नहीं हुई अभी तक. Somehow that is no longer the case now, and marriageable age is gradually increasing in India, and most urban middle class individuals generally marry after their 25th birthday. So this is the age range during which we settle down in marriages, have a family, have kids, have responsibilities, and our attitude towards money changes quite drastically. Instead of spending money now and living in the present and enjoying the present, we start having concerns for the future. We start saving for future. Very few exceptions would be there where you find individual in this range not saving anything at all. And it is generally this age range where we generally tend to or would like to be financially independent and not taking money from parents. So if you consider the modern trend in India, this is also the age range in which we buy our first home, and that we do with the help of a generous bank loan. So we are indebted, and to repay that loan we work. So now our surplus income is the income left to us after meeting our basic needs of food, shelter and clothing, plus paying off the debt. So since age is not very high and we are new to the job, usually our salaries are not very high. So we have a moderate income with often high expenditure because there are young children to look after and there is not much accumulated wealth since we have just started earning. So the financial needs during these ages are loans to meet the cost of buying homes and other high expenditure items, maybe a dream car, club membership and things like that. Worried about what will happen to dependents should something happen to them. So such a pretty picture will get spoiled. So this is the age range where the need for life insurance is felt. So in a developed country, this is the age range where we get the most first time life insurance policy order. I do not mean to say that it is not possible for people to buy policy in these ages. It is possible, but that is generally you may ask yourself also in the mirror that buying the life insurance policy is generally not driven by financial needs of providing protection to their children, etc. That is generally driven by some tax incentive. So it is some sort of tax incentive that prompts us to buy a life insurance product even if we don't have dependents. So then it is these ages where it is felt that health insurance is also required. Some sort of financial planning to ensure a smooth and steadily rising standard of living, it is also felt that some financial planning is required. This is what I meant when I said that the attitude toward money changes. Rather than living in the present, enjoying the present, spending on desires and fancies, we tend to become prudent, we tend to take a longer term view of our needs and our dependent needs, and we start saving. Next comes the age range 35 to 65. Accumulation of wealth to flaunt in society as a form of security, as a means to smoothen standard of living, is also prominently felt in these ages. We tend to accumulate wealth, and generally children are getting older, getting into higher education, and ultimately before I reach 65 my children will become independent, debts reduce, they fall, the home loan might be prepaid, right? Income may increase with promotion and experience, increased skill set, so income may increase and income might exceed expenditure, and that gives a way to fulfill our desire of accumulation of wealth. But there are some risks. The risk is what if we are laid off from the job? What if there is some disruptive technique? What if there is some new development and my skills are no longer required? I become unemployed. So this risk is there. And with that, income protection insurance, some sort of income protection is required, both right now and in retirement. So retirement planning, pension, attitude toward pension, very few people start thinking of pension at these ages. If at all they do, that is actually part of the financial plan when they take a wholesome view. But during these ages, pension and retirement planning becomes a very important motive, and people do take active efforts, steps towards retirement planning. And one more requirement that is felt is long-term care. What if I live longer than the usual life expectancy. What if I live to ages 95? Okay. You want to know what is the problem in living to 95? Okay. First think of a person aged 70. Right? The person who is age 70 and who married at age 25 may have a son or a daughter at age 30. So the age of that kid will be 40. A 40-year-old is well equipped to mentally, financially, emotionally. A 40-year-old can be a natural caregiver to a 70-year-old. So this person can be looked after by his natural caregiver, by his children. But think of a person surviving to age 95 with a child born at age 30. So the child is now 65-year-old. Don't expect a 65-year-old life to be a care provider, to be a caregiver to another life. Neither financially, nor emotionally, nor physically, this life will be in a situation to provide care, attention needed by the 95-year-old. So this is the problem of living longer than we have been living as human beings. Right? Now, think of the problem at age 105, they will further be compounded. And it is quite possible that the life which is aged 105, the son or the daughter that was born at age 30 may have already left the world. So there may not be any natural caregiver. And even if that natural caregiver is present on the face of earth, that person would be incapable of providing care. So for such person, the only way is paid care. And who will pay for that care? Out of savings only. That is possible out of savings only. Or we have some other arrangement that we will discuss in other chapters. If you recall your CA1, we have discussed continuing care committees, continuing care retirement committees, a mechanism developed in USA. So you think that this is not a big problem, then you should look at the data from Japan. This is a very big problem. France, Norway. If you look at these countries' data, then you will realize that living very long poses what sort of problems. What sort of problems. So we have discussed financial goals, financial resources and financial outgoes at various ages while the person is working. Now consider when the person is not working. Ages 65 plus, 65 and above. At these ages, we may say that hardly any of us are going to have dependent. Hardly any of us are going to have dependent. So dependence would not be an issue. We ourselves would be dependents, right? So no dependent means we have to take care of our own needs only, right? But no income. If you recall from my first video, income either comes from your own physical labor or mental labor, or it comes from non-labor sources like dividends on shares, interest on bonds, royalty on your books and rent from your property. So surely there will be no labor income. There may be some non-labor income in the form of pension, in the form of rent, in the form of interest, in the form of dividend. So whatever income would be there at this age, that would surely be a non-labor income, and expenditure at these ages depend on two things. First of all, medical condition. And second, spouse, whether there is a partner or not. So if there is a partner, there is some sort of emotional well-being is there. We can talk and actually share time with someone, and whether that spouse has his or her own non-labor income sources or not, right? So these are the ages at which people move from employment into retirement. There are few deaths, all deaths have been discharged by now, but there is much lower income, and that too in the form of non-labor income. There may be accumulated wealth depending upon how well finances have been managed over the lifetime. There may be huge accumulated wealth or very little accumulated wealth. So the main risk is, what if I am eating out of wealth and I outlive my source of income. I survive longer than my stream of income. So what if I have to go into long-term care? These are the main risks. So because of these risks, it is quite possible that all of the non-labor income that is earned may not be spent, and some sort of saving is done for long-term care. And in some cases, there may be another reason to save at these ages, and that is leaving something for the next generation, that is called inheritance. So with that, we round up the topic of typical life cycle of a person, and we move to other topics. Please note that this introduction will set a tone of how to approach the chapters that follow, and in that direction, the very important thing that you should keep in mind is that how and why life insurance products have evolved over time. So, evolution. Basically, this is an overview. It is not loaded with too much details. It is just to give you a broad idea. Details will follow in the chapter that we do. So, evolution of life insurance products over time. So, let us have a rough sketch of this evolution, and I would be writing little and speaking more. First of all, that motivation for this evolution came from two things. First of all, changing needs. Over the calendar years, people's needs have changed drastically. Then changing risk attitude. We have been risk averse, we are still risk averse, but the risk aversion may have reduced or may have increased. So that changing risk attitude and the changing needs have been the main motivation, main driver of this evolution. And when I say changing risk attitude, changing risk appetite, it applies to both the insured as well as the insurer. So risk appetite have changed for both. Now, before we look into the evolution, there is a touchstone. There is a what you call litmus test, whether a product will ultimately succeed, whether a product will be a long-term success or not. There is a very simple quick test for that, and the test is that for success, commercial success, long-term success, the product must provide some useful benefit to the customer. The product must provide some useful benefit to the end consumer, end user, where the premiums are reasonable, premiums are seen as reasonable, the cost is seen as reasonable, and benefit is seen as useful. This is one side of the coin. Another side of the coin, that for commercially successful product design that gives a long run, that proves a long run success, the risks of the product must be reasonably manageable and the product must be adequately profitable to the insurer. This is the other side of the coin, right? The user of the product should feel that the benefit that is being offered, that is being given by the product is useful to me. It will plug some of the gaps in my personal life financial life cycle. It will provide me with income at a time when I will have lesser income as compared to expenditure, or it will help me save at a time when I have more income than my expenses. So, if the benefit is seen as useful and the cost is seen as reasonable, that will give you good demand for that product. But demand alone does not matter, there has to be supply also. So, for a good supply of such products, there has to be an insurer who finds that the risks involved in offering such a benefit are reasonably manageable and the resulting profit is adequate enough to justify doing the business. That is the touchstone or the litmus test of a success of a life insurance product, right? And please note that it is in the nature of life insurance contract that both premiums and benefits are somehow contingent either on death or survival of the insured life. Additionally, there may be a benefit on discontinuance called surrender or withdrawal. May be, may not be. But there has to be some benefit either on death or on survival or on both. So death and survival would always matter. Surrender or withdrawal may figure as a benefit event or may not figure as benefit event, right? Now we come to, with these opening comments, now we come to discuss product design evolution. Before we consider the evolution, let us talk of the original design. The original design of the life insurance product was to offer a guaranteed benefit. Whether it is a death benefit or whether it is a survival benefit or whether there are both the benefits in the same policy, the original design was to offer guaranteed benefits, either death benefit or maturity benefit or both, in return of guaranteed premium, in returns of specified premiums. The amount of the premium is specified or guaranteed, but how many premiums would be paid, that can't be guaranteed because that is contingent on the death of the insured. So premiums were usually paid till death or for a shorter period, whichever is earlier. Now, After evolution of lot more other type of life insurance products, now these products are referred to as non-profit, non-linked insurance products. Non-profit does not mean we are doing a charitable business, we are running an NGO. This is just a terminology of our subject that whatever profits accrue in the product, we do not share it with our policy holders, because there is a class of products called with profit product that we come to in a short while. In that type of product, whatever profit accrues, a part of that is declared back as bonus or increase in sum assured for the insured life. Now, so the original design is guaranteed or fixed benefits in return of fixed premiums payable till death or if death occurs before that fixed term, then premium is stopped with death. If death does not occur within the fixed term, then the premium is stopped after the fixed term is over. That was the original design. Now, of course, you may go a step back and you may find a variation to this also. But that is not the part of today's video. Details, as I said, will come later on in higher chapters. Next, the first evolution after this original design is that let us move away from guaranteed benefits, right? So now, after first evolution, only a part of the benefit is fixed. Fixed or guaranteed in advance, and another part of the benefit is discretionary. Discretionary in nature. So, if my experience allows me to declare benefit, I will declare. If my experience does not allow me to declare benefit, I will not declare. So that means some of the risk is passed on to the insured life. So, I repeat, only part of the benefit is guaranteed. The remainder is discretionary at the discretion of insurer, who considers the experience before declaring the benefit. And please note that in this first evolution, premium, there has been no change with premium. Premiums have been fixed and they are payable till death or a fixed term, whichever is earlier. So what the insurer has done with this first evolution? In this first evolution, we see that the risk attitude of the insurer has increased. The insurer has become more risk averse and insured has become less risk averse. Risk aversion, of course you can write the same thing, but you can change the word appetite. Instead of risk attitude, you may write appetite. Then you will say that the risk appetite of the insured has increased and the risk appetite of the insurer has fallen. So there is a risk transfer from insurer to insured. So some of the risk In the original design, all the risks were borne by the insurer. In the first evolution, which we now call with profits policies, some of the risk is borne by the insured also. And over time, the with profit policy also evolved on the premium side, and in some cases there was a contract design in which even premium was subject to revision. In some cases, insurer retained the right to revise the premium. Now, such products where only a part of the benefit is guaranteed and another part of the benefit is discretionary depending upon the discretion and experience of the insurer, nowadays such products are known as with profits or participating policies. And in the jargon of the industry, in the lingo of the industry, participating is reduced to par. It is common that if you meet a senior who has been working for long in life insurance industry, he or she will utter the word par product, par policy in place of participating product or participating policy. And the fund that they have to manage these policies, that is also referred to as par fund. Par policyholder, participating policyholders are often referred to as par policyholders, right? So this was the first evolution. In the second evolution, we moved one step further, and there are no guaranteed benefits. At least on maturity. On survival, there are no guaranteed benefits. There was some minimum guaranteed level of benefit on death, but there was no guaranteed benefit on survival altogether. And premiums were as before, not much change on the premium side. And now these products that came after the second evolution of life insurance product journey, now such products are referred to as unit linked or ULIP, unit linked insurance plans, ULIPs. What happens in a ULIP? Almost the entire investment risk is transferred from insurer to the insured. According to the mandate given by the insured, his or her premiums are invested in a fund, and howsoever the fund performs, well or poorly, good or bad, that is reported to the policyholder, and various charges are deducted from that fund to meet insurer's expenses, and whatever amount is there in the fund account, that is the benefit that the policyholder is entitled to receive. In other words, in this second evolution of life insurance product, the benefit amount is actually decided by reference to the underlying assets. How much assets do we hold as of now, right? So the size of the value of the asset determines the value of the benefit. Note, whenever there is a benefit payable on surrender, its amount is not guaranteed. In all of these three designs, whether everything is guaranteed, where death and survival benefit were both guaranteed, even in that design, surrender benefit was neither guaranteed nor contractual. There was no contractual obligation. In many contracts, there may not be any surrender benefit. Even if it is there, its amount is never known at the outset, and there is no contractual obligation to pay any such amount. And that continues with the evolutions, that continues with the with profit contract. But when it comes to unit linked contract, then the definition of surrender benefit becomes quite easy. Maybe some surrender penalty may be levied, but when we say the fund belongs to you, the fund belongs to the policyholder, and the policyholder says that I am unwilling or unable to continue with this arrangement, then logically the policyholder should have the right to the fund that belongs to him or her. Now, Next, what is withdrawal? Withdrawal may have two forms: lapse or surrender. When the policyholder is unable to continue with the arrangement or able but unwilling to continue with the arrangement, unwilling to pay future premiums, then there are two possibilities. First is, nothing is payable in return of the premiums paid till the date of discontinuing. If that is the case, then the policy is said to lapse. But it is quite possible that some benefit, some amount is payable in return of premiums paid till the date of discontinuing, and in that case that benefit is called surrender benefit, surrender value, and that surrender benefit, surrender value is paid to the policyholder and the policy is said to be surrendered. And both these are ways of discontinuing the policy. So there is a chapter of discontinuance where we discuss various aspects of discontinuance. This is an overview of discontinuance. So a policyholder may withdraw, and when the policyholder decides to withdraw from the agreement, something may be payable, nothing may be payable. If nothing is payable by the insurer, then it is called lapse. If something is payable, that something is paid, that something is called surrender value, that surrender value is paid and the policy is over at that time, it is called surrender. Now there is another option, and that is called paid up option. If the policyholder is unwilling or unable to continue with the arrangement, then the policy may become a paid up policy, and in a paid up policy, the sum assured is a term that is used in life insurance industry to denote the size of the benefit that the insurer is liable to pay. So the sum assured is reduced to reflect the premiums paid till date, and then the policy continues. This is not discontinuance. Nothing is paid at the time of withdrawal, something is paid at the time of withdrawal, and the policy ends. Nothing is paid at the time of withdrawal, but something would be paid on the event against which protection is sought. That may be death or maturity. So nothing is paid when the policyholder intimates us that I do not want to continue with the arrangement, I am unable to pay future premiums, or I am unwilling to pay future premiums. Then at that time we pay nothing. The policy remains in force, the sum assured is reduced, and that sum assured would actually be paid on the event. Let us say it is a term assurance, and then the policyholder does not die during the remaining term, then nothing would be payable. Suppose it is an endowment assurance. So if the policyholder dies within the remaining term, then the sum assured will be paid to the reduced sum assured is paid to the dependent, and if the policyholder survives to the end of the policy, then the reduced sum assured is paid to the policyholder. This is what paid up means. Now next topic. What factors we consider before deciding this reduced sum assured, that will come in a later chapter. Right. Next is Risks to insurer. When a life insurer sells a policy, what are the risks? Broadly speaking, these risks may be classified in as micro risk and macro risk. What is the basis of classification? On what basis we call a risk micro or macro? That is not much important. Mortality risk, expense risk, investment risk, and inflation risk are faced by insurer. To what extent, that depends upon the design. The first design, guaranteed benefit, will have different extent of risk. The second design, part of the benefit is guaranteed, part discretionary, the risk would be, the extent of the risk would be different. The third design, nothing guaranteed, the benefit is determined by the underlying asset, then the extent of risk faced would be different. So, no detailed comments here. Next is business volume risk, exposure risk and insurance risk. Now, please note that this is to be covered in great detail in later chapters. But one note, one comment that I must make right now is that the type of product, whether it is endowment assurance, whole life assurance or term assurance or annuity, so the type of the product and product design both have significant impact on risks. Which risk matters to what extent to the insurer? That depends upon two things: type of the product and design of the product. Next is, let us have a quick recap of your subject CT5. A very quick recap of subject CT5. From CT5, there is a lot that will be used and recalled in ST2, but right now I only want you to recall something about expenses. Expenses that you did in chapter 7 CT5. When it comes to expenses, you know that insurer generally provide for the expenses according to the time at which they are incurred. And the first in this category is initial expenses incurred at the outset, renewal expenses incurred regularly on receipt of each premium or on each policy anniversary, and final or termination expenses incurred at the time of claim payment, benefit payment. So, what all factors would you like to include in initial expenses? Please note that initial expenses are significant because they cover marketing expenses, they cover underwriting expenses, and most probably they will cover a portion of product development expenses also. Apart from that, they will have information technology related expenses where the new policy must be entered into the IT system of the company. Administration expenses, right? Issuing the policy bond, ensuring that all details are recorded correctly, right credits are given to who sold the policy, how the policy was sold, and then sales commission, perhaps restricted by the regulations, or regulation may not have a say in that. So all these components go in determining the initial expenses. Then it comes to renewal expenses. Renewal expenses mostly relate to premium collection expenses, and with the use of technology where you can swipe a card or have ECS, electronic cash transfer settlement, if these type of technologies are used, then this cost of premium collection can be reduced. Actuarial valuation costs, renewal commissions, perhaps depending upon product type, product design, and may be regulated by the regulation. These are the components of renewal expenses. When it comes to final or terminal expenses, it basically claim verification costs, claim settlement costs, and closing out the policy from the computer system, IT system of the company, plus other admin costs determine how much will be incurred at the end, right? The second thing I would like you to recap from your CT5 is that when it comes to reserving, we always did prudent reserving. In other words, the basis used for reserving was always stricter than the basis used for pricing. If I talk of the strictness, then the strictness, or we say pessimism. So, what if we consider more what if at the time of reserving than we considered at the time of setting the premiums. So what does it mean? The investor has to put his own money to set up these reserves, because whatever is coming to us from the customer may not be sufficient to meet the cost given additional what ifs have been added. Whatever what ifs have been considered at the time of pricing, premium would be sufficient to meet the cost of those contingencies only. But here we consider additional contingencies, and to meet those additional contingencies, the premium would likely to be insufficient, most likely to be insufficient. So the remaining money must be invested by the insurer, and this gives rise to a concept called new business strain. New business strain. For selling any new policy, the investor must first invest his own funds. So, at the time of reserving, we are taking a grimmer view of the future than we did at the time of pricing. We are considering more what ifs. So, reserving basis is always stricter than the pricing basis. This mandates that capital has to be kept aside to ensure a high probability of being able to pay the claims even with all these what ifs, right? In other words, even if the experience worsens than what I assumed at the time of pricing, I have a commitment to still pay the benefits. So, in that case, I would be paying those benefits out of my own. Some of the part of the benefit I would be paying out of my own pocket. So how much money might be needed at that time? That money will not be arranged at that time. That money must be arranged in advance, and hence new business strain. Right? I must tell you that I was reading an article on internet which told me that nobody needs actuarial science for doing insurance business. Nobody needs actuarial science to sell insurance. And I was quite surprised by that assertion. But in the very next statement, the article says that, but if the insurer wants to survive in the long run, if the insurer wants to do it scientifically, not ad hoc, not on an ad hoc basis, then there is no alternative than to make use of actuarial science. So the actuarial science is a science that will tell us that what if the experience worsens, how much money would be needed. And it also tells us that don't believe for a day that whenever that additional money would be needed, at that time we will be able to arrange that. No. We must arrange it as early as possible. Why not today itself? So that gives rise to new business strain. So what are the implications of this new business strain? So let us introduce in another topic, asset share. Of course, the next video is on asset share itself, but an overview of asset share is in order, right? So in the first year, it is quite possible that the size of initial expenses exceed the first premium received. In that case, there will be negative cash flow for the insurer, and that negative cash flow means that a part of the initial expenses would be met out of insurer's own finances and not out of the premium charged from the policy holder, right? Not only a part of the initial expense plus whatever money has to be set aside in reserves. Whatever money has to be set aside in reserve. So asset share of the insurer immediately after selling the policy would be negative, and that would be excess of initial expenses over premium minus reserve to be maintained at time 0 plus, and this would be a negative number, right? This is one possibility. In addition, there may be some statutory capital requirement, and if that is there, the asset share will turn more negative. And let us call this a statutory capital requirement by SC. So if that is there, it will become further negative, right? Now the second possibility is that I is smaller than P, but still because of these two terms, asset share may still be negative, right? Third case is that premium is very, very large as compared to initial. Maybe you sold a 25-year policy with a single premium. So you got a very large premium, and in that case the asset share may not be negative, but even then it will be slightly positive, or maybe just on the verge of being zero, because whatever premium you have received, a large part of it you must put aside in reserve, right? So asset share at time 0 turning out to be positive is extremely rare, if not out and out impossible, right? So next is what all contracts we are going to cover in this course, or in other words, products sold by life insurer, right? We make 3 classes for that. The first class, endowment assurance, that is covered in chapter 1. The second class is further broken down into 3 categories: whole life assurance, term assurance, and convertible or renewable term assurance. This we cover in chapter 2. Then the third category, annuities. It is further broken down into 2 categories: immediate annuity and deferred annuity. That is covered in chapter 3. And fourth is ABC, that is endowment, whole life or annuity, may be either written on no profit, non-profit, non-linked basis, or they may be written on with profit base, with profit design, or they may be written with unit linked design, or they may even be index linked. So in fourth chapter we consider design. In fifth chapter, that is our very next video, we consider asset share. We consider asset share in detail. So all this we cover in detail in our next video, video number 3. Now, I would round up this video with a comment on the ST2 exam. It is a myth that is going around in student circles that being a part of the life insurance industry, having worked in the life insurance industry, is a definite plus in cracking ST2 exam. Industry knowledge is more important than common sense. Industry knowledge is more important than applying yourself. I say it is a plain myth and rubbish. This may be true, this myth may be true for a person with some 12 to 15 years experience in life insurance, because I reasonably assume that over such a period the person would have had first-hand experience of pricing, first-hand experience of reserving, first-hand experience of underwriting related issues, first-hand experience of investment strategy, first-hand experience of options and guarantees, first-hand experience of capital requirement, capital projections, first-hand experience in solvency, first-hand in ULIP, first-hand experience in surplus analysis and declaration of bonuses, distribution of surplus, right? So what about those who do not have such a long experience and they are working in life insurance industry? So in your first year or first 2 years, you may have some idea of reserving. And that is quite possible that you know what factors to consider while individual reserving, and you have no idea that group reserving may be another cup of tea altogether, group business reserving, right? So it is not possible that in your 6 month or 2 year or 3-4 years experience you get an overview of all the varied functions of a life insurance industry. But do you think that your ST2 exam is going to be focused on just reserving of individual product? All 100 marks will be given for this. So much for insurance, so much for industry knowledge, right? Your ST2 exam is likely to be having a wide coverage, covering as many of these functions as possible, and you can't bring industry knowledge of all these functions if you have not been working for a very, very long period in the life insurance industry. So if industry knowledge is very important, if industry knowledge is critical for cracking ST2 exam, then that much industry knowledge can be acquired only over a span of 12 to 15 years. So do you think that people pass ST2 only after working 12 to 15 years? Statistics do not tell this. Statistics tell quite the contrary. Most people who crack ST2 may not have yet started in life insurance industry, or may have just started in the life insurance industry, may just have a year or two, half a year's experience in the life insurance industry, right? And the more industry knowledge you have, the more intensive you tend to be in that particular domain, and of all other domains you may not be that intensive, and then you may be very conscious about that. I do not know that much details. So sometimes it may work against you. So what I recommend is that rubbish this myth, believe in common sense. But common sense alone is not sufficient. Please note that. Second is applying yourself. So this is the key to cracking ST2. Thank you very much. This is all in video 2.